I'm Dan Weaver, Head of Innovation for Equifax and leading the Equifax Open Banking Programme. And I'm joined today by Steve Baker.
Hi everyone, Steve Baker, Head of Open Banking Analytics at Equifax.
And we're talking today about what we see as some exciting new developments in open banking, in particular how we view the future of credit scoring will involve bank account information and lead to better lender and consumer outcomes. So on with the show. So first of all, where is open banking being used today? And through ourselves and our partner AccountScore, we're working with over 100 clients currently, but the predominant use case that is live in market is affordability. And what do we mean by that? It's helping lenders with their regulatory obligations around responsible lending, and in particular, income verification, income estimation, and estimating expenditure. And we're seeing open banking is providing organisations with benefits that include just the improved granularity from viewing bank statements. We're seeing increased income verification rates and looking at using income verification from bank account information in combination with existing turnover-based methods of income verification. We're seeing that some organisations are benefiting, increasing their verification rates by 10 to 20% from using bank account information on top of those methods. And we're also seeing
Dan, sorry, just jumping in there. I just wanted to highlight some of the benefits. The granularity of the data is what really allows us to leverage the open banking data. And whilst you said it's 10 to 20% increment on the verification, it's up to 50% of the people that actually fail traditional income verification methods that we're able to verify.
And then that's it, also seeing benefits in terms of use in this COVID-19 period. So using the bank account information to assess whether people are on furlough, and then as hopefully we, in 2021, we come out of the COVID scenario, I think that there's going to be benefit in obtaining that bank account information so that we can view a customer's income and salary payments as they move away from furlough and back onto full-time salaries. So proven benefits in affordability, but where is open banking heading next for lenders? And we see the key next challenge that we'd like to tackle is one of credit scoring. So what is credit scoring? A quick definition on screen, but hopefully we're all familiar with credit scores. We have them ourselves. It's a statistic analysis performed by lenders to assess a person's creditworthiness. So that there are lots of different scores in the market. Each of the credit bureaus has a number of credit scores. Lenders also develop their own credit scores. But the data assets that lenders are using to develop their scores today is pretty common in that it's centered around credit bureau data. So what does that credit bureau data look like? And I've just highlighted on screen kind of like the typical data sets. There are others as well, but these are the most common that lenders are using. And this data would involve looking at somebody's credit payment history. Are they up to date or in arrears? What different credit account types does a customer have? Mortgage, credit card, a personal loan. Looking at their balances and utilization, how long the credit agreements have been open. Are they making credit searches? So lots and lots of information on the credit that a customer has today. We do augment that with some other data sets as well that are listed there, but the key element of one's credit score is credit payment data. And you know, this has proven to be very successful because of its high coverage, high accuracy. It's very relevant, it's consistent, and we can build predictive models based off historical data and then implement these models going forward, and they prove to be very accurate. But is it perfect? And I don't think it is perfect, and that's where bank account information can help. So what information are we looking at using in credit scores from the bank account information? Just highlighted a few of the key components on screen. So within, if you take your own bank statement, The key elements in that are a person's income and salary. We can also see pensions, benefits. Then we've got the rent and council tax payments that are not included in a credit file, so we can view that information as well. We can see all sorts of other committed expenditures, insurance payments, utilities payments, subscription payments, and also looking at customers' cash flow and how they do they have money in their account, or is there a kind of deterioration in the cash flow over time? There's also some other elements like the credit repayments and overdraft usage, which kind of are also observed within the credit information, but most of the information we're seeing in the bank account is actually new to a credit bureau, and so basically that's separate to what we're seeing today currently. And just like the credit information, the bank account information also has many of the same key data properties that you need in order to consider the data for statistical modelling. So it's got high coverage because most consumers have a bank account. It's accurate. It comes straight from the bank's online banking platforms. It's complete in terms of an income and expenditure. You can aggregate multiple accounts. You could also, if you want, pull in credit card information. So it contains many of the same features that mean it's very useful for statistical modelling. So then if we look at a particular subset of customers, thin file customers, how are we combining these two data assets together? And a thin file customer is typically one that doesn't have very many or any at all credit accounts. And so you can see on screen a kind of example of this is that you don't have the credit payment history, the credit account types, the balances and utilization in which to make a creditworthiness assessment. So there's very little information on the credit bureau in which to credit score this customer. So I think it doesn't take a genius to work out in these cases, if you add bank account information to this person's data, that you're creating a more holistic data set from which to credit score this customer. And at Equifax, we've done exactly this. We've taken our existing Equifax credit score, we've then added in bank account information and created what we've called the 360 score that combines both credit and bank account information data items. And we've seen real large benefits in doing this, and a plus 20% improvement in the predictive power of this credit score on this thin file segment from combining these data assets. And why do we think that's important? We think because having more accurate and more inclusive credit scores will lead to better lending decisions, which will benefit both the lender itself and also the end consumer as well.
And Dan, just to interject again, sorry, I just want to highlight that we actually do improve the predictive power across the whole population, not just the thin file population. So whilst we maximise performance for thin files, actually for everyone that gets a traditional credit score, we can improve the power by over 10% if you combine traditional data and open banking data.
So very quickly moving on as well. So we think bank account information also has other properties that mean it's particularly useful. So just on screen, we're having a look at the factors. Why do we think consumers miss credit repayments? And assuming it's not fraud and that the consumer wants to make a payment, what we're trying to highlight on screen here is that there's a difference between correlation and causation. And in particular, the bank account information has more of those direct factors that we think mean, and you can identify that consumers could potentially miss those payments in future. So things like an income shock, deteriorating cash flow, change in personal circumstances, and lack of financial resilience. You can see that in the bank account information, and that could be a direct reason why a consumer might miss a credit payment. Whereas if you compare on the other side, things that are correlated with credit performance, things like being on the electoral roll and length of being on the electoral roll, the number of credit accounts, that we would say is, whilst correlated with future credit performance, being on the electoral roll or not doesn't have a direct influence on whether the customer will make a credit repayment or not. So we see more benefits beyond just thin file and moving to the full sample of population. So on that note, passing over to Steve to talk through a bit of characteristic analysis.
Thanks, Dan. We've pulled some example characteristics that are hot topics at the moment, many of which feed into the 360 score that we've developed at Equifax. And before we jump into them, one of the important things that determine how predictive a characteristic is how easy it is to identify that attribute within an open banking account and how many people actually display that behavior. We'll come on to that a little bit as we work down this table. For those that are into their stats, before we were talking around genies, so traditionally used to compare the measure of scores. Here we've used the information value, and basically it just allows us to rank the predictive power of individual attributes or characteristics depending upon what country you're from. Here, obviously, the most predictive attribute that we've shown in the table is our 360 score. So the blend of both traditional credit scores and our open banking credit score. You can also see other traditional attributes such as credit card utilization, the time since that you missed a payment on the credit bureau, and the amount of time that you've been on the electoral roll. All significant characteristics and highly ranked in their predictive power. What you then see is in the open banking characteristics, the one that really stands out is individuals' monthly income, how much money they've got going into their account, how much they're earning, and that's by far the most powerful attribute that we see, outperforming many of our credit characteristics. And when we go to some of the other attributes, so some of those behaviours and payments that we don't traditionally see on a bureau, council tax, rental payments, subscription streaming services, and then payments for savings, ISAs, and then another predictive one which we managed to see in open banking data is returned payments or bounce payments or overdraft charges, or any type of negative payment within your open banking data is also very predictive of, in this case, a bad credit risk. A lot of these other observing payments, such as rental savings, council tax, are all very predictive of positive credit risk. So you do get both of these nuances of trying to separate the good from the bad consumer. I'm jumping on to the next slide. When we create a score from these, we put them all together and combine our open banking score and our bureau score. And whilst before we showed the performance on the fin segment, we've broken this out into a couple of other segments. What we traditionally do in the bureau is we'll have multiple subpopulations of consumers. We group similar consumers together. Here we've taken a simplified version, so consumers that historically have never shown any past serious derogatory behaviour. That would be they've never defaulted on a product, they've never had a CCJ. Consumers that are thin file. In this case, we've used a broad thin file. You've got less than 5 years credit history, less than 3 accounts on the bureau, and then everyone else we've called clean. And here you can see that combining the two data assets and the two scores adds a lot of power across all of these different segments. And while that's important for a lender, it's also very important for a consumer. What we do see is we can actually enhance over 50% of a consumer's credit scores, and 20% stay about the same and around 30% decrease. But for those 50% that have an improvement in the score, that can lead to them getting better offers and better rates on the products that they're applying for. I'm going to move on to the final slide and pass back over to Dan for a little bit of a wrap up. And thanks for that, Dan.
So that's it. Just to wrap up, that this is it. We believe the future of credit scoring is combining both traditional credit data and bank account information. We're live in market with a couple of products, the Financial Health Index and the 360 score. And so Very happy to talk to organisations about how to implement solutions such as this and gain the benefit from using bank account information for credit risk. Thank you very much.
Hi everyone, and thanks for joining us for the second session on the main stage today on day 3. Delighted to be joined by both Steve and Dan from Equifax for live Q&A. Good morning, gents. How are you?
Good, thanks.
Very good, thank you.
Perfect. There's quite a few questions for us to get through, so I'm going to dive straight in. Steve, I think you're probably best placed to answer this, and Dan, chip in if required. Are there examples when a consumer would score worse than their traditional score when account data is added? In what circumstances might this happen, i.e. which new account metrics? So Steve, I'll come to you first, my friend.
Cool. Quick answer, yes. And I'll get on to the long answer now. So the good thing about any data asset, as well as all of the stuff that Dan spoke about around coverage, accuracy, is the ability of that data asset to have positive and negative identifiers within it. And what this means is, if I'm a analyst at a lender, I want to make the best lending decision. So I want my score to accept or reject people based on the probability of them going bad. So I want my score to best reflect an individual consumer. In open banking data, we have the positive attributes such as making payments back, but then we do have a lot of negative attributes such as missed payments, overdraft charges, returned payments. One of the big benefits of the open banking data is it's real time. So quite often this will highlight gaps in traditional data. So that 4-week time horizon that you may have from a traditional bureau score, you can close with the open banking data. So if there's been short-term high cost lending taken out, and those sort of negative indicators can highlight that there's a increased risk of default, and so your score would decrease. And just before I finish, I'd like to say, whilst we have developed our score so that it does increase and decrease, and we've sort of enhanced our credit application score, we can actually enhance any score, and it's really up to the lender to decide whether they want to reflect the negative aspect in the sort of enhanced score or just show the positive. Thanks. And Dan, anything for you?
Nope, all good.
That's good, because I'm coming to you next, Dan, on this next one. So thanks for that, Steve. So this one's coming at it from a collections perspective, both from looking at kind of debt collection agencies and then internal collections teams, potentially within the lenders themselves. What's your view on debt collection agencies or collections teams utilising open banking data when doing I&E checks? Is it being utilised enough? And what's the future there, I guess, is probably the question being asked. So over to you on that one, Dan.
Yep. So we've had a number of successes in that space to date, and absolutely we're engaged with lenders and their collections departments. We're also looking at like the payment holidays as well as collections. I'm also talking to the likes of the debt charities and DCAs as well about implementing open banking for automated I&E. And so absolutely, I think it has a big role to play in that it can take the complex standard financial statement, and if we can simplify that for the end user, and by pre-populating some of the items from use of both open banking and the credit report, I think there's big consumer benefits in doing that. And we're starting to see that at the moment. And so some of the clients that we're working with, we're reducing what can be a complex for standard financial statement form that can take up to hours to fill in, and reduce that to minutes. So from the operational side, it really does reduce the time, makes it easier for the customer. It's not going to be for everybody, but we're seeing real engagement. Probably about 50% of people that are offered it want to use this automated open banking service to help pre-populate and automate their I&E. So I think it has a big role to play. Is everybody using it at the moment? No, they're not. But I think, you know, that the initial signs, use case and benefit statements for both consumers and collections departments is proving to be substantial. So I just see the take up increasing.
Great stuff. Thanks, Dan. I'm probably going to come back to you on this next one as well. So we've discussed then kind of the I&E elements and ultimately how that can be utilised a bit more broadly across financial services. And we've also discussed how utilising open banking data can not only have a positive and a negative impact on a consumer's profile. I guess a more broader question then, in terms of kind of the markets that you're serving. Be interesting to someone's just mentioned, you know, which markets are you currently active in, and I guess where are you seeing kind of most success right now?
Yep. So thinking about that one. So if we take all of, you know, Equifax's core business, we're in data aggregation, platforms, decisioning, analytics. Open banking is our leading product, working with our partner account score. So we have more kind of like leads with more clients in open banking than we have for any other Equifax product at the moment. So I really do think we're seeing the mass take up and adoption of open banking. Not everybody's yet live with open banking, but pretty much everybody that we talk to in every market has an open banking plan, strategy. They're working through that. Some are undertaking proof of concepts. Others are moving from the proof of concepts to API integrations and real-time automated decisioning. So in terms of the markets, I think it really is, you know, it covers everything, all of the markets Equifax deals with. But some of the early mass adopters, I would say, are auto finance, where particularly for income and expenditure, we've seen good penetration of that market. But in terms of all finance, cards, loans, mortgages, we've got real examples for each of those markets that we're live working with clients. You know, also live with credit brokers as well. So a consumer looking for a credit option, they can consent to share their bank transaction data with the broker. The broker can find and identify the best deal for them. So we really have got everything sort of like, you know, from top to bottom. But in commercial lending, I suppose, there's one thing we've not really spoken about today, but we've got a number of clients that are live combining credit information, open accountancy data and bank account information. Same kind of use cases of making better lending decisions and just working out the income and expenditure of a business as well as the consumer. So that's it. Really is lots.
Great stuff. Thanks, Dan. I think it'd be interesting as we go into next year, you know, as we look at that curve of open banking adoption across multiple products, either through necessity because of you know, the pandemic, or through innovation. So really keen to keep an eye on your journey as we go into next year. So to Dan, to Steve, and the broader Equifax team, many thanks for taking the time to join us today, and we look forward to welcoming you back to an event soon. And to our audience, you now have the opportunity to choose between the other 3 stages if you have a VIP premium pass. So many thanks all, and take care.